Thanks for tuning into this broadcast of Navigating Through Uncertainty. And boy, are we in an uncertain period? Yes, we are. And do we need some good voices to tell us or guide us as to how to go through this? Well, we've got one such voice for you. Manish Chokhani of ENAM joins us right now with his thoughts. Manish, good having you. Thanks much for taking the time out and speaking to us today.
Thanks for having me, Neeraj.
No, pleasure is ours. We seem to be priced for perfection about 2,500 points ago. Everybody thought that we would go through calm waters, and I think the scene has just turned upside down. Was this natural to happen, or do you think do you think that this is not done as yet?
So the first thing is, Neeraj, you'll recall we met informally. I think, was it a month ago?
Yes.
And it wasn't calm waters, which is why everyone was kind of staying a bit away from the media. And also, I think most smart money would have created some cash, because you didn't know something like this was going to come for sure, but that something was going to happen to upset the apple cart was kind of, I think, guessed in the system, because everyone kept talking about how narrow the leadership has become, and it's just 10 or 15 kind of companies holding the markets up. And it seemed to imply that it was a lot of ETF flows which were kind of becoming price agnostic and just kept driving the same stocks onward and upward. And I think what you're seeing now is really a reversal exactly of that system playing out, where you know that these are now price agnostic algorithms or ETFs effectively selling down. And it's not happening on volume, but each tick which is down, the computer is going to just keep ticking and keeping on trying to depress the prices further. So like you cannot call a complete top in the market when it's going up and it went beyond anyone's imagination, I don't think anyone can potentially tell you what is the exact bottom of the market, but it certainly feels and smells like panic and despondency and depression, or call it what. Having said that, the real world effects of this haven't yet played out. And what is that effect once the market sees and it can then price it in? I think that's when you'll probably get a firmer bottom. And again, the opposite of a top in the market is when you see a falling top, falling bottom formation. You would probably have to see a kind of rising top, rising bottom formation for you to be clear that there is now a sustainable bottom in place. So I don't see that as yet. But for most investors who have the right asset allocation and who have some cash, it's a time to start thinking about what do I really want to buy, and keep your pencil sharpened for that, because I presume it's the last 5 or 10% cash which everyone is holding on to, which becomes very, very crucial for you to not again, put that last 5-10% to work and take a pounding on that as well.
So you're not talking about writing on the pages as of now. You're only talking about sharpening the pencils. Is it because you don't see a floor to prices and valuations, or you don't see a floor to the time, because that is a bit of an imponderable as to when does the panic around this subside?
So, I'll refer back to two gurus who I follow a lot. One is Stanley Druckenmiller, who said it very well, that in the past, when he built positions, he kind of sized them up and then he built it on the way up. But given the rise of computer trading and their ability to pick patterns, he says the speed of the move has now become so fast that you don't really get time to build up your positions. And it kind of compresses what would have happened in 30-40 days in probably a week, which is what, again, you saw now in the fall, which earlier used to happen in, say, 30 to 60 days, has kind of happened in probably 20 days this time. Because like I said, the algos are at work and they see the pattern and they just hammer the whole thing down. So similarly, on the way up, whenever that occurs, the move will be sharp, but it's not like if you miss one day, you miss the entire move. And you will see that pattern playing out over 2-3 days, the way you saw it on the way down as well now. And again, please understand, when fundamentals on the way up cease to matter beyond a certain price point and stocks just kept going up on their own momentum, it's kind of the same thing which happens on the way down as well. But beyond the price, the fundamentals in effect cease to matter. And it's really the tick-by-tick selling which is really depressing the prices here. And my guru, the founder of ENAM, Manik Bhai, used to say it very well to me that when you think prices are not right, don't be in a rush to sell it. You just shift it from in your own mind, from your fundamental portfolio to your kind of technical portfolio, if you may call it that, and wait for the rising top, rising bottom formation to be broken, and then just sell it on the way down. And the same logic would apply also on the way up, that let the bottom formation be formed, and then you can go in.
Wow, interesting. There's a lot of technical talk out there as well. But Manish,
so it's a way of reading what the market is giving you as a signal. So because a lot of prices are much below fundamental levels, and we weren't disputing that. If you leave apart 30 companies, I think already by end of last year and beginning of this year, the broader market was clearly devastated, and it was kind of signaling to you that the economy is not going to recover in a rush. And even fundamentally, if you recall when we spoke, there are two material changes, I think, which have occurred in the psyche of the Indian system. Number one, a lot of promoters used to build their companies on 2:1 leverage. And given what has happened to a lot of the leverage players who got taken out, I don't think you'll see that level of leverage anymore in projects which come up. Number two, the profit cycle is so depressed that you're probably sub 3% profit share to GDP. So if you take the combination of you don't have enough profit to reinvest, and the amount of leverage you're going to apply to do your expansion is going to be that much lower, it means you're going to be growing at a probably lower trajectory than what you were used to. And that impinges back on what, therefore, your fundamental valuation is.
Manish, you gave us a very interesting chart about what the previous cycles have done, both, I mean, when we hit a bear market or even otherwise as well. Now, my question is, when you liken the current bear market, and I'm using the term because of the levels and the technical definition, how do you compare this to the previous ones? Does it smell different? Does it feel different? And therefore, will it turn out different? Is it possible to predict that? Because somebody was telling me that at times history gives you a template, but at times history is being made as we speak.
Yeah, that's right. So we say that history never repeats, it rhymes. And the closest analogy I could remember to this was 1987, when it just completely fell off a cliff. And that was the end of the emerging market bull market, when Japan and Taiwan had gone up in the 80s almost 10 to 12 times. And the US was cutting rates very dramatically, and there was a roaring bull market. And you got that complete panic on that manic Monday in, I think, October 87. When I still remember, I was just getting out of college. But the recovery after that lasted for almost 2.5 years. And it gave you a very good sort of CAGR even from there, until it was again interrupted by the Gulf War. And then the US in particular had a roaring bull market with the whole TMT era of the 1990s. Although we suffered in Asia from the Asian crisis and the LTCM blow up and so on. But it culminated in that glorious 2000 massive blowout globally, which then kind of led to what was the next commodities and emerging market story of the 2000s. But moral of the story is bear markets are often sharp and swift, and they last for maybe 1 or 2 or 3 years. But bull markets tend to be the nature of human society being that we kind of trend upwards. And again, to take the example of, say, the last decade after 2008 bust, you probably in aggregate had 2 years of kind of bad days, and in aggregate you probably had 8 years of good days. So on balance, if you're thinking you were better off being in rather than out, and if you missed those bad days, you certainly missed a lot of the action in the markets. So which is why I'm saying these times it's not kind of extinction level event which is occurring in the world. It is certainly kind of something which simultaneously you're getting demand compression because people don't go out and they can't shop, and that is what really causes recessions. And you also have a supply side shock because factory workers can't get to their factory, office workers aren't getting to their offices, and therefore you have a supply side shock as well. But at some point when this blows over, and it inevitably does, because mankind will find some solution, and whether it is 2 months away or 6 months away, all the stuff which has kind of gapped down, you would start finding the same upward ticks applying at that point. And you would also start then filling in the supply chain and the inventory chain, which would have probably run dry right now. A lot of the panic buying which is taking care on retail shelves as we speak. And then the inventory starts getting filled up, and that whole recovery cycle occurs. But that is still some time away.
Okay, you kind of preempted my question. I was going to ask you about the current demand and supply shocks. So, but in order to get a sense of how long can this last, if it's even possible to predict, what happens, Manish, if this spirals a bit more in the West? The last weekend gone by, we've seen this happening in Europe. What if this spirals more in the Western region and even in India for that matter? We'll get to India in a bit. Can this worsen the price route and the time zone?
So it's very interesting here that for the last 10 or 15 years, we've been speaking of the fact that the developed world as we know it, the West, is in some kind of decline with aging demographics and a very over-leveraged society. And it's the East which is rising and powered by the rise of China, and hopefully someday India will catch up as well. But reality is the amount of leverage in the world is 3.5 times the level of GDP. And while the leading stocks, for example, in FANG, are throwing out cash by the bucket load, or people like Berkshire Hathaway are sitting on, say, 130 billion of cash, the below investment grade market in the US to me is the real source of trouble in the world. The below investment grade market in Europe is a source of trouble in financial terms. And the second thing I've observed is while China, Korea, Singapore have all handled this crisis in the real world very, very well. And in fact, you haven't seen a rise in the cases coming out of China after that magic 81,000 infected patients number. The way it's been handled in Europe and the way, I must confess, it was handled in the US till now is frankly been very disappointing. And the UK, I read, is kind of banking on a theory called herd immunity. So rather than trying to flatten the spread of this disease by doing quarantines and keeping social interactions limited, the UK is kind of deciding like, let this crisis hit and we will get immunity somehow. And what X number of people might have fatality, but then we'll have immunization automatically and life will carry on. And even US was fairly relaxed. If you saw a lot of the statements of President Trump, he started with complete denial to kind of saying, oh, it's nothing great and life will go back to normal. So I think you will start seeing US doing a lockdown very, very shortly, maybe even today or tomorrow, because they're just 10 days behind Italy in terms of the outbreak. And if they're not able to spread this, flatten the curve as it were, and at the same time handle their financial markets and below investment grade market, which is why the Fed has been kind of panicking so badly. And in that sense, rightly so, at least their financial markets, they're trying their best to keep it in shape. But the real economy hasn't been handled so well in the US. So what I think will happen is the Asian side will recover faster. And China is already starting to ship goods out. Korea already is back on its feet. Japan seems to be gearing up still for the Olympics. Singapore seems to be okay. Hong Kong seems to be okay. So the eastern side of the universe seems to be okay. And the West seems to be just entering into a period of a mess. So it'll be interesting how this plays out. And I, for one, am certainly watching what happens to currencies and the transmission through debt markets over here. Because equities are like the temperature gauge. We get instant kind of corrections here. But it takes a bit longer to play out in currency markets and certainly debt markets.
You reckon that things could get imbalanced compared to what we've seen in the past 12 months on the currency side, Manish?
Yeah, it's been foxing me for a long time that how is it someone keeps printing money and keeps dropping interest rates and the currency keeps appreciating. So at some point we have to realize, for example, if you take the Indian example, that $475 billion of reserves is effectively money being lent to somebody who's printing it in 6 months at a zero cost. Whereas we would have been more better served by, say, using at least 150 billion of this to buy oil futures at 150 and thereby keep our economy on even keel for the next, at least 2 years. So those kinds of structural changes, because the institutional setup will not allow RBI to go and buy oil futures. The parliament still hasn't allowed someone to go and buy oil futures. But all these things will now start coming into people's heads. And you hopefully will start seeing a kind of change in how the world thinks and acts and behaves at an institutional level as well.
Okay. Now, Manish, India, we've reacted quite a bit already on the back of what's happened in terms of cases in the world. I mean, in the West, China, etc., etc. Not quite in India. What happens if the number of cases in India shoot up? Because I think we are also at that crucial period where a few countries were from where the cases really shot up. What happens if the same happens in India?
So, well, number one, let's accept that India has handled this really well. I think our administration reacted very quickly by shutting down influx of foreigners, putting out flights from. It's unheard of for India to say we won't allow people from Europe and Middle East to land into India and stuff like that. And we're tracking very well up till today. And what you're trying to do obviously is flatten the curve out. Having said that, the expectation is in the world that common cold is not going to get eliminated, or influenza is not going to get eliminated. The world, when it gets its act together, has eliminated smallpox. And at some point, we will get to that as well. But if we can keep the curve flattened out, our healthcare system can cope with it. If it becomes a case like Italy, where it just went viral, and you started getting a 6x expansion on a weekly basis, then of course it's unmanageable. But on all evidence you have today, India seems to have a lid on what's going on. And honestly, even if the 100 cases we currently have become 1,000 or 5,000, it's still manageable. But you certainly can't manage when it starts becoming 100,000 and 150,000, which so far doesn't seem to be the case. So I don't think we should be so spooked about it right now. And this is a crucial week. I think if we can cross this hump, given the quarantine we've put into the country and stopped infected people from coming in, I think we should be in much, much better shape.
Yeah.
And like I said, on balance, Asia has handled it far better than the developed West, which kind of was in complacency mode that our healthcare systems are great. And this is an Asian problem and it's not going to come visit us.
Yeah, but should it happen, Manish? Hopefully it doesn't. But should it spike a bit? What happens to the financial market sentiment, which is already fragile? Is it baking in that spike, or you don't think the markets have baked that in as yet?
Look, our financial markets have really been driven by what's going on in the world, and a lot of the selling has occurred by what's again happened in the world. And again, like I said, a lot of it is driven by what these algorithms are doing, rather than a human being sitting there and pulling the trigger and saying, let's sell this stock down 20%. So, will this become worse if India becomes worse? I don't think people are imagining that India is, not going to be worse, if I may call it that, sitting in the West. And it's those guys who are at the margin, really the bulk sellers. Whereas in India, it's really become an absence of buying, because even if there's someone like me, I'll say I got, 10%, 11% cash. Let me hold on and buy on an uptick. So, and like I said again, when a computer is selling against you, you can never say till what price they're going to keep selling. So let's just wait and watch.
Okay, well, but yeah, read between the lines as well. But Manish, tell us then, what happens to the first order, second order, third order effects? I mean, to that whole bunch of sectors which are already getting impacted as a result of the quarantine and the shutdowns, and then the second order effect because people can't spend.
Yeah. So I said that already, right? So the financial markets in some sense are pricing in what is going to happen, assuming this is a 1 year of a lost year of revenues and profits.
Okay.
If you see fundamentals, there are a lot of companies which are trading on a trailing basis of, let's say, 4 or 5 times earnings. Assume those earnings repeat, or they are down even by 10 or 15%. When that stock comes back and you're trading stocks eventually on terminal and sustainable values, what happens to those companies? So I think markets are certainly pricing in the worst in a fundamental sense today. But like you said, the effect of that in terms of earnings will only be seen in the forthcoming quarter and maybe the quarter after that. And I'll give you a very small anecdote from some of the companies where I'm involved. Companies selling products on the consumer side are finding that their sales have actually shot up currently because consumers are in a buying panic in the real world. And they're cleaning the shelves out for provisions, personal hygiene products, and so on. So from that perspective, these guys are doing great right now. But they know that next quarter, if people aren't going to go out and buy, what's going to happen to them is next quarter earnings are not going to be great. If this persists, quarter two may be even worse. But the stock market at that point will say, oh, what we thought is going to be so bad is not as bad as what we thought. And therefore, prices might move ahead of that rather than keep falling when they see these bad results. So a lot of this price action is, in a sense, anticipating the second and third order effects. And what you're rightly saying, it's concurrently a demand and a supply shock, which is going on currently.
Okay. So
I even spoke to someone, for instance, who kind of getting a lot of inward inquiries from people who say, I don't want to now have all my eggs in the China basket, and we want to get it done from India. But now this guy doesn't know if he produces and he ships, whether it will reach the docks. First of all, whether his workers will be in the factory 2 weeks from now. If they do produce, when it goes to the docks, will they be put on the ships? And when they reach the United States, well, as there'll be people who will take it off the containers from ships arriving from India. And then is there someone to put it actually physically on the stores to actually sell to consumers? So a lot of these ifs and buts will occur in the next 3-6 months. And it's only when market starts pricing and seeing things beyond that you start seeing the big jumps at that point.
So Manish, can I infer that you're not waiting for valuations in the current cycle? You're not waiting for valuations to be right. You're waiting for clarity and the time to be right.
I think valuations are really interesting already. But like I said, in the golden words, you wait for that kind of rising top, rising bottom type of indication from the market. And at which point this market will, if it gets that W formation, the computers will again take over and not really give you a big chance. But let's assume you're thinking stocks could now be a triple from here or a quadruple from here, or even a double from here. If the stock is, you're going to miss the first 10% move, does it really matter to you? Because the bulk of the up move is still left. And also you're forgetting most people would be 90% in the market already. So it's really you're talking about that last 10%, that can I make a 3x, 4x on this and kind of bring my overall IRR back. For people who haven't been in the market, of course, it's fortunate. And if your asset allocation is skewed in favor of debt or other products, and if you have that dry powder, then if you can get your asset allocation back, because now the allocation of equity must have fallen, given what's happened to price damage over here, then you have a great chance to actually rebalance your portfolio, and there will be a lot of wealth creation which people will remember from this period. The same way we remember whatever we bought in 2008-9 actually just created tremendous amount of compounding from there. And I'm assuming, of course, we will buy the right companies and not buy the weaker balance sheets and the weaker leaders and so on. And we'll talk about that. What are the 3-4 types of things that one could be looking at as well?
I actually come to that, but just before that, one thing, and because I wanted to ask this question to you earlier, you mentioned at the start of the interaction that value buying was absent, those narrow 20-30 companies were leading, and that's unraveled now. A lot of people said it works until it stops working. Now it stopped working.
Yes.
Would you believe value buying will come back, or would you believe growth will still take precedence?
Yeah. No, look, eventually there's no growth, there's no value. You don't keep on buying something which will have flat operating earnings and just have cash flows. Because unlike in the West, where interest rates are very low, and companies actually have indulged in a lot of buybacks and thereby kept the EPS growth going and kept their multiples elevated in the context of low interest rates. India has got higher interest rate than it should, and it's got a higher taxation regime than it should on buybacks, for example. So at some level, you will start seeing a floor being created because people will say, I don't care. Like, even if you take me as an example, there are businesses which traditionally I would have never looked at. But if I see them now at literally 4 times earning multiple, and on a cash earning multiple of probably 2 times payback in that sense, I frankly don't care. And at certain time you just say I'm okay to buy this, and maybe I could make 4x if I wait, but I'm okay to make a 3x if I buy it right now. So there will be some emergence of that going on. And you also know some of these companies will have now earning growth because they are going to benefit from better pricing and kind of better volume expansion as well, given that business will shift away from China to India as well.
Okay.
So I mean, short answer is yes.
Okay. So when Manish Chokhani buys depends on that W, the golden words. What does Manish Chokhani look to buy?
So I've thought of it in kind of 4 ways, and I'd encourage people. Obviously, there are 100 ways to skin the cat. This is just the way I'm thinking currently. That number one, do I know that my company is bulletproof enough to be around 3 years from now and continue to be a market leader? And the easiest example to give people, and not that I'm suggesting they buy that, but if you think of the carnage which has happened, say, in the banking sector, you know that 5 banks are now going to have disproportionate market share gains, whether it's SBI, ICICI, Axis Bank, HDFC Bank, and Kotak. In terms of pricing, at least I would say 3, if not 4 out of these 5 have become very, very interesting from a pricing perspective. Can they get juicier? Answer is yes. But I know if they're around 3 years, 4 years from now, they're going to be disproportionately larger and probably have better return numbers. And there's no current reason for their valuation multiples to not regress back to mean, which may be 2.5, 3 times book value, or 15, 20 times earning multiples. So it's very likely something like that happens. Again, if you see what's happening if people are sitting at home, the opposite of what is happening to the hospitality and travel industry may be happening to the media industry. Also, given what's happened to the availability of easy capital for people, throwing you free bundles of telecom services or OTT services, I think that goes away. And it makes it very interesting for what happens to pricing in telecom and media space as well, given also the number of players have shrunk over here. So it already gives you a heads up that if your portfolio is kind of tilted to some of these types of leaders, what's going to happen to them in 2 or 3 years could be very, very interesting. So that's kind of phase 1 and bucket 1. A little bit down the road, what you would expect to see is the kind of thing I'm talking about, where some of the Indian companies start taking benefit of this shift in global supply chains. And it may be in chemicals, it may be in textiles, it may be in a variety of other areas. And again, there are very few people who have the balance sheet and the guts to go out and do this right now. Because like I said, availability of capital, as well as if you're very tired with what's happened to you in the last cycle, you're not going to be in a big mood to go and expand today. But there are enough number of players out there who could be beneficiaries of this. And that becomes kind of thematically the next export basket to start looking at. And I'm not even going down the path of what happens to IT and pharma and API and all those people. As the world becomes even more double down on moving, say, the chemical API chain away from China to countries like India. So it could be interesting over there as well, and it's category 2. Category 3, and 3 and 4, I don't know what the sort of sequencing will be. But if we do manage to pull off something on the privatization bit, on BPCL, Concor, Air India, the complete devastation that one has seen in public sector assets, I don't think continues forever. And if people do start getting excited that 3, 4, 5 more of these companies will get privatized, and at least some of us have great memories of the wealth creation which occurred in the 2002, 3, 4 cycle when Hindustan Zinc, IPCL, Maruti and all were kind of given away to private hands. There is wealth creation opportunity in some of these companies as well, which one would look at very carefully. And the fourth, which is probably still 6 months away, is when the kind of world starts fixing itself and the supply chains come back. You tend to see commodity players going back to the sort of 85th percentile of the cost curve. And today, a lot of these prices are probably at the 40 to 50th percentile of where the cost curves are. And if those prices then come back to the 85th percentile, and the fear of that no one's going to buy anything from them for the next 3-6 months because China is dead and Europe is dead and US is dead and so on, you probably get an expansion in their pricing, their EBITDAs, and also in their kind of multiples at that point. And those could become potentially very, very large compounders for you as well. So while traditionally I like to be in higher quality companies, at times like this you get very, very lucrative and juicy trades, if you will call it that, which over a 1-2 year horizon could be like 3x and 4x kind of returns. So that's just kind of the lay of the land the way I see it today.
Yeah, that's very interesting and very helpful.
And again, I mean, the leaders of the past round, which have been our consumer stocks, are still trading at very crazy levels, and I can't see them continuing to lead in the next cycle. I think leadership will change as well.
As it usually does. So history may not repeat, but as it rhymes, as Manish said. Manish, just one final thought on this then. We're seeing a bit of an issue on the domestic side as well, because the GDP print isn't the strongest and this may cripple it further. And the globe isn't ship shape. Usually in the past, we had one of the two at least in fairly decent shape. So if you were to place a bet right now, would you be on the domestic facing, inward facing companies, or would it be export oriented companies? And just a brief on what recovers first. Would it be the local factors or would it be the global factors?
So I gave you that sense of how I'm seeing it, that it's what's been happening in India is, even while the economy has not been doing well, what's happening is that those who are actually better managed and better governed are disproportionately gaining market share, which is why I gave you the banking example. that while the Indian banking sector was kind of melting over the last 5 years, if you happen to be in the HDFCs and the Kotaks of the world, you gained disproportionately. And as you've seen the cleanup of the corporate cycle, and the ICICIs and the Axis have also gone towards, retail lending, their gains have again started getting magnified, especially as the tier 2 type of private banks, and Yes and others being examples of that, have kind of faded as well in the background. So it doesn't really matter if the GDP print is 4%. You don't make money out of GDP growth, you make money out of earnings growth. And where people are gaining disproportionate market share, I think that story continues. Like I gave you the telecom example, maybe nothing happens to the GDP, but will the ARPUs in telecom, will the ARPUs in media, will they be significantly better? And is the range of players narrower over there? And therefore, is the earnings prospect much better over there? It's again examples of where the economy may not be doing anything great, but you could be doing fantastically. And just take the same US analogy that you get innovation. And if the US was growing at 2-3% and you took the dim view about what's going to happen in US, you missed the whole ride of all these Google, Amazon, Microsoft, and so on over the last decade. So there is always interesting things to do if you're focused on the businesses. And while you get a tailwind, the tailwind for me now is people with better managerial capability and better balance sheets are the guys who are going to win this game. And it applies whether, like I said, it's banking or media or commodities, manufacturing. There are few people who are going to become disproportionately large. And it's certainly worth looking at all of them.
Okay, fair call. I mean, I was just wondering whether you had a thought on whether the export-oriented themes, or rather the global markets will probably resurrect themselves quicker than the Indian markets or otherwise.
No, I mean, if you're asking me that, I think the West has kind of gone over the cliff and been running kind of on thin air, like the famous case of, when the guy sold a Rolls-Royce engine to a Maharaja, and he went back 4 days later saying, I've been driving this car for 4 days and now I realize there's no engine inside the car. And the answer he got was, it's been running on reputation. It seems to be a bit of the case with the West, that they've kind of pulled wool over everyone's eyes for the last decade, printing almost $3-4 trillion, running at negative interest rates, and we kept going to them as safe havens. And I think you'll realize when the debt markets in the West blow up, that these are not actually safe havens. In the past, you thought of the West having solvency and not having liquidity. And you thought of emerging markets as not having liquidity, and there were solvency issues. And I think the game is exactly opposite now, where our markets actually have the solvency now because we've cleaned our systems substantially. And the West and Europe and a lot of the kind of junk bond kind of companies in US are living on hand to mouth on a week to week basis, which is why the Fed has been panicking so badly. Which is why you see that 0% interest rate coming in the US. Because if that market blows up, it's trillions and trillions of dollars over there. And there is no comeback from there. I mean, to put in context, our entire market cap probably is close to $1.5 or $1.7 trillion. And the sub-investment grade market in the US is a big multiple of that. And there's no way you're going to recover that. So let's see how it plays out.
Let's see how it plays out. But very interesting thoughts, Manish Chokhani. Thank you so much, as always, for speaking to us at BloombergQuint. Really appreciate your time.
Thanks, Ryan.
Our pleasure is ours. And viewers, thanks for tuning into this broadcast.